Hello everyone, this is Paresh Desai from Sankalp Eduventture. Today we are going to see how to take trades for options in the Zerodha platform. The options in Zerodha platform are available for four categories. Number one, for equity, then second for the indices, third for commodities, and fourth is for the currencies. So let us start with the first category, which is options for equity. Now, the chart which you're seeing here in front of you is a chart of Infosys 1600 CE. So basically, if you want to find out which options are there, which stocks are for options, you'll have to go and see the site of NSE, and only those stocks which are there in futures and options you can buy or sell the options. Now, if I want to buy, let us say, Infosys calls, then I will have to decide the strike price. Once I've decided the strike price, let us say the Infosys price right now, which I find is somewhere around 1602, and I want that I want to buy a 1600 call, assuming that I have a bullish view. So I put 1600 and then I put CE. CE is called European, and then I give a space and then I say Infosys, or you can type Infi also. So these three options will be available. Now the options for the stocks or the shares are basically for a monthly expiry. So this one, what you see here, is for July, the next one is for August, and next one is for September. You can select depending upon at what is the expiry or how far the expiry is when you're taking a trade. So that will again depend on your technicals. So let us say if you decide to buy a July option for 1600 call for Infosys, then this is how you're going to execute it. You click on the buy button. Once you click on this buy button, then you get an option whether you want for intraday or whether you want for overnight. So if you want for intraday, then obviously it has to be squared off before the end of the day by 3:20, because if you don't square off before 3:20, some penalty might be applicable to you, and the trade will automatically anyways get cancelled by the end of the day. If you cancel it before 3:20, then the penalty will not be applicable. For intraday options, you'll find that the margin required is little less. The same thing if you are going to keep it for overnight, then the margin required will be more. Now the lot size which is given here is of 600. So by default in the Zerodha platform, the lot size would come here by default, and the last price which was there for the premium would be showing here. So depending upon whether you want to go for a market order or you want to go for a limit order, you can select the price here and execute the buy button. So if you want to, let's say, buy on the market basis, if you click market, whatever is the next best seller who wants to sell the options, you're going to get that price. If you put a limit price, then you could put a limit price as per your choice. It could be lower or it could be higher also, depending upon what your technical analysis says. So once you go and select the buy signal or the buy symbol, the order is going to be placed and you'll be able to see the orders over here. So if it is executed, then it will show as executed, then it's going to show in your positions. If it is not yet executed, then it will be going to show as a pending order, and you can always monitor to see whether your order has been executed or not. If you see here, there's one N nudge. It says that the contract will be physically settled on expiry and requires additional physical delivery margin. Now because the expiry is very close, the broker can ask you for additional margins. So you'll have to be careful, because if you take a trade and the price or this option becomes in the money, then the broker will ask you for additional margin. If that additional margin is not provided in time, then the trade can be cancelled by the broker, and that's a right which we have given to the broker to cancel the trade if the margin is not given. So this is for a call option, and as you know, once the trade is executed, it's going to go in the positions. If you want to exit from that, if you want to sell what you already bought, you want to square off, you have to go in positions. In the positions, you'll find that there'll be a 1600 call of Infosys. Go over there, select on the three dots, and on the three dots you'll find an exit button. And then once you say exit, then a red window will open like this, 1600 CE of Infosys, and it is going to show like this once you go for the exit button. So you can exit at whatever price is there at that point of time. Let's say if it is increased, then you can select the limit or the market depending upon what is your choice at that point of time. It is better to exit at the market price, because sometimes if the price is just spiking up, then you might get a good market price also. And at the time of entry, you have to be a little careful. Avoid taking a trade on market basis while entering the trade, because of the volatility. Sometimes you might find that you might get a high price and then the price might immediately come down too. So while taking a trade, it is better to trade on the market basis, and while exiting, depending upon where you are exiting, most of the time it will be better if you exit on the limit price. So this was how you can buy a call. Okay, so for buying a call, you don't require a margin. You require only the margin required is much lesser, but you can also go short in the market. Let's say your view on Infosys is bearish, then you can actually sell this call. So you can go to 1600 CE, and if you say Infosys, and if you, let's say your view is bearish, you could actually first take a short position. You could actually sell the call, and if you're selling the call, obviously can you see the margin required is quite high. It's almost like 1,73,000 approximately. So this is the margin required when you are selling any options. So for selling options you require margin, but for buying options you need only the amount of the premium multiplied by the lot size. So if you want to sell, then you require this much margin in your account. Only then this trade will get executed. The profit would be the amount of the premium between the selling price and the buying price. So here the process will be opposite. You sell first and you buy later on when you want to square off. So this was about options for the shares. The second category is for indices. Now in indices, we have got three indices in India which you can trade. First one is Nifty. So let us see where Nifty is. So if the Nifty find is somewhere 15,746, and you think that Nifty, you want to buy an option for Nifty, you could buy 15,700 call, let us say. So I'm going to say as 15,700 call, 15,000 CE, 700 CE, and you can say Nifty. Okay, the moment you put 15,700, you'll get all these options. So can you see that is July, August, and then you see the days also. Once you see 5th August, 12th August, 18th August, right? So in August you find 1, 2, 3, 4, right? And then there is one more. There should be one more in August, in the 25th of August, right? So in August you will find, if you see here, in August there will be, it looks like there are 5 expiries. Now Nifty and the indices, if you are seeing, would be having a weekly expiry. So that's the reason why you're finding this every week, and these expiries are on the Thursday of every week. So the next expiry which is going to come, now we are on 28th of July, and the next expiry is on the Thursday. So if you go on July, if it is saying only July, then this is the last Thursday of the month. Otherwise the dates would come like this, 5th, 12th, 18th, and so on. So if you see only July, it would mean that is the last week of that month. So if you want to buy a call, 15,700 call, then same way how you would have bought a stock index, and so you can select your buy. Same principle, intraday or overnight. You can, the quantity by default for Nifty has become now 50 units. Earlier it was 75, now it is 50 units. So it is little more, you can say the participation you can expect a little bit more, because then the quantity of the lot size has reduced. And if you see here, the price which is showing is 81 rupees, which was the last price. So if you select 81 and you want to buy this, the margin required would be the actually only the amount of premium which you are paying to the seller. So you require 40502 buy this nifty call, and this call will be expiring on Thursday, which is on 29th of July. So once you buy it, same principle, it's going to go in the options with the positions, and while selling you can go in the positions, click on the three dots and go on the exit. Similarly, if you have got a bearish view on Nifty, you can actually sell the Nifty calls first, right? So this is a short trade. So if you have a bearish view, then you can go to the same 15700 CE of Nifty, and instead of buying first, now since your view is bearish, you sell first. Okay, so the moment you say sell, this window will open. Now the margin required, can you see, is around 1,01,000. So for selling of the call, you require huge margin, which in this case is 1,01,611. But while buying, you require only the premiums. So as a seller, you require margin to sell. So if you are a short, you need to have higher margins, and your profit is going to be the premium which you have collected. So same thing, instead of a long position, you take a short position. In a short position, you sell first, and while squaring off, you actually buy. So the process is opposite. You sell first and you buy later on. There are three indices which you can trade. One is Nifty, one is Bank Nifty, and third is Fin Nifty, that is finance Nifty. So if you go to Bank Nifty, you'll find that all these calls would be there, right? So these calls are for Bank Nifty. Bank Nifty is around 34,797, and if you put 34,800 CE and you say Bank Nifty, then you'll find that again July 34,800 July, and 34,800 C is there. You can buy it. If you want to buy it, then you have to pay the premium. If you want to sell it first, that is if you're going short, then you have to arrange for the entire margin, which is quite high. So if you want to if you are an options buyer, then you require less margin. If you're an options seller, the margin required is quite high. It could be ranging around 1 to 1.5 lakhs also. In case of companies or in case of shares, sometimes the amount of margin required could go sometimes as high as maybe 3 to 4 lakhs also, depending upon the lot size. So this is how you can buy a call. Now similar to the call, you also have a put. Yes. So if let's say if you are bearish on Nifty and you find that Nifty is at, let's say, 15,746, and you think that it is going to go down, then you actually buy, you can actually buy a put of 15,700. Okay, so if you buy a 15,700 put, you have to say 15,700 PE and put a space, and you will get all the options. So July for 15,700 put, this July is the last week, and if you buy a put, then you'll be taking a bearish position, and you can actually buy a put. If the price goes down, you'll make money. If it goes up, probably this the premium which you're paying would end up being zero if you don't square off till the end of the contract. So if I put 44 rupees, which was the last price, then you can still buy this put at a very low price of just 2,200. So when the period is very close to the expiry, you'll find that the margins required is much lesser. Towards the beginning of the month or towards the beginning of the week, the margins are higher, but as we come towards the expiry, the margins reduce because the time value keeps on reducing. So you can buy a Bank Nifty, you can buy a Nifty, you can also buy a Fin Nifty contract. So if you're going for a Fin Nifty, you can see, can you see there, Fin Nifty also you can buy contracts for, I'm just going to put CE and I put Fin Nifty, right? Can you see 12,400 CE Fin Nifty July, right? So all these are for July. You will find for different strike price, 12,400, 12,500, 12,600. Let us see where is the Fin Nifty right now. So if Fin Nifty is at Nifty Financial Services is at 16,500, and let's say I want to take a 16,500 call. So if I can say 16,500 CE Fin Nifty. Okay, can you see? All these, again, this is the weekly contract. So the last week for July contract will be your last day of last Thursday. Okay, so Thursday of the week, and you can buy a call of Fin Nifty the same way how you would have bought a Nifty or a Bank Nifty. Right? You can see what are the components of Fin Nifty by going to the NSE site. So these were the indices which you can trade. Now the third category which you can trade is the commodities. So commodities like, let us say, gold. If you see where the gold is right now, the gold is somewhere at a level of 47,500. If I got a bullish view and if I think that gold would be going up, then probably I can buy a 47,500 call. So I say 47,500 CE of gold, then all these contracts would be showing up, but these are not weekly contracts. This the next contract which you see is of July, the one after that is September, and then after that is November. Okay, so sometimes the contracts can be every month, sometimes they could be after every 2 months also. So the contract for gold for the next expiry is in July, and then there will be September and November. So same way like how you bought the options for the stock, then for the indices you can also buy for the commodities like gold, silver, and other precious metals, and you can also buy for crude as well. So similar one, again you can say buy for 47,500, and if you see what is the margin required, the margin required would be 3,600, which is a very, because now the time value is much lesser. That's the reason why you're finding that this is so cheap. Otherwise this premium can be quite high also. So same way like how you bought the call for equity or for the indices, you can buy for the precious metals like gold and silver also. The fourth category which you see is for the currencies. In currencies, if let us say it is 74.50 right now, and I want to buy a 74.5 call of USD INR. Okay, so can you see, you can also buy the options contract for the currencies, right? So if you got USD INR, then you got Euro, then you got GBP. So there are 4 to 5 currencies which you can trade in futures as well as for options. So same thing here, if you want to buy, you can go for the select the buy, and depending on whether you want to buy at the market or you want to buy it for the limit price, you can buy it. Suppose if I want to buy over here, I say 74.5 CE, so by default this will be 1, and the margin required will be 2.5, but this one would be for 1000 units. Okay, so again the margin you can pay for the margin. Similarly, if you want to sell this contract, okay, for selling obviously you are going to require a huge margin. You can sell this contract also, and if you sell the contract, the margin required obviously is going to be higher over here. So if I take the margin required here, and if I say let's say 1 or something, the margin required is going to be somewhere around 2000 for this part. Now this is because these are currency contracts, the margin requirements are quite low, and you can take advantage of the low investment which are required here. So these were the 4 segments in which you can trade the options. You can buy options, you can sell options, you can buy puts, and you can sell put also. So related to the puts, one more time I can show you for the stocks. Let's say if you got a bearish view on Reliance, let us say, you find that okay, Reliance is going down, I think it's going to go even below, and what you could do is you could actually take a put of 2060. Okay, so if you take a 2060 put, then you will say 2060 PE, and you say Reliance. Once you do that, you can buy a Reliance put. Okay, and the lot size for Reliance is 250. All the shares will be having different lot sizes, and Reliance lot size is of 250. You pay a premium of 15 rupees, right? And what you require would be around 42,000 for this particular put. So this is for a bearish view. So you can, if the price falls below this also, then if the price continues fall, the margin would increase and you would be actually in profit. So if your view is bullish, you can buy a call. If your view is bearish, you can buy a put, right? So this was for buying the put. Similarly, you can buy the puts for the indices, the commodities, and also the currencies. So friends, if you like this video, please don't forget to press on the icon which is there on the right hand side for the subscribe button, and if you have got any suggestions, you can put it in the comment box. Also, if you like to meet me live, sometimes when I take the live webinars, you can go through the details given here below this video, and there'll be some important links, some useful links which you can click, and you can be part of the community and part of the group which is there on the Facebook also. So do refer to the details which are there below this video and take advantage of this. So once again, this is Paresh Desai, Sankalp Eduventture once again, and thank you very much and see you soon.